Greetings everyone, welcome. Joe Soto here, founder of the Joe Soto Project, where we help individual investors navigate the world of Wall Street, understand the financial services industry, so they can make the best decisions for themselves and for their family. Let me ask you a question. Do you have a 401k, an investment account? Maybe you're using a financial advisor, maybe you're using a robo-advisor, maybe you have some accounts online, and you wonder, okay, in this environment with all this uncertainty, there are all these different types of stocks. There are all these different types of bonds. There are all these different types of ETFs. There are all these different types of mutual funds. What the heck do you buy in this environment? Where do you invest? And let me tell you, I can totally relate to that, because not only do I have to make those decisions for myself, but I have multiple families, right, that I help through my family office firm. I am a fiduciary financial advisor, and I have to make those decisions not only for myself, but for my clients. And I could tell you that the world of investing today has definitely gotten a lot more challenging. And one of the things that I wanted to do with you today is I wanted to share with you some of the fundamentals and share with you, some of the basic principles, some of the basic investment vehicles that are out there. A lot of times people invest money in vehicles, they invest money in the stock market, and oftentimes they don't understand what it is that they own. So there was a story in the media that kind of broke my heart and triggered me to talk about this particular topic for this week's blog post at joesotoproject.com. You know, there was a kid, I say a kid, but he was an adult actually. I think he was mid-20s at Robinhood, right? And he opened up an account. What was fascinating about this, right? Today it's so easy to invest. I mean, anybody with a phone can invest, right? So he opened up an account, and, rising tide lifts all boats. He was doing well in the market, and he was investing, and somehow he got caught up in getting a credit line on his investment account. This is called a margin account. So what this guy did, I'll give you an example. So let's say you have $100,000 in an investment account. You can borrow, depending on the firm, $60,000 to $80,000 on that $100,000. So now he's not trading with $100,000, right? He's trading with $160,000, $180,000. Well, guess what? When this whole coronavirus thing hit, all these investments that he made on credit, they came back to haunt him. Okay, and the article read that I think it was right around $500,000. You got this person that's in their mid-20s that was investing online, self-prescribing his own investment prescriptions, and it blew up on him, and he killed himself. And that just breaks my heart, because I think, I don't know, maybe doctors feel the same way. When they have a patient and maybe they felt that you feel kind of like, man, we should have done a little bit better as a professional services industry for somebody to disappear from this world, take their own lives because they didn't have the tools, the education, the understanding of investing. And not only is he's no longer here, but think about his family. I mean, it's devastating. This is one of the reasons why I'm so passionate about educating in this field. Not only does it keep me sharp because I got to be in tune with what's going on, but, I think if one person like him was to heard my messages, to heard maybe a message that I made, and he became a better investor or a better, more educated person in the industry, maybe people can feel a little bit more empowered and not make such bad decisions when it comes to investing in Wall Street and the market. So, it broke my heart, that story. Anyway, so today what I want to talk about is some of the fundamentals on some basic principles like, say, stocks, bonds, ETFs, and mutual funds. Those cover a big chunk of the market. Now, the list is not all inclusive, because it would make for a 10-hour video probably. And I'm gonna be working on a course on some education in this component. But for today, we're going to talk about 4 key principles. And we're going to talk about stocks, bonds, mutual funds, and ETFs. A lot of times people invest in the stock market. They have stocks, they have bonds, they have mutual funds, they have ETFs. And just like this gentleman in Robinhood, maybe they didn't understand how the things work. So today, I'm going to give you a brief summary so you can have a general understanding on some basic principles about how these vehicles work. So without further ado, let's get started. The first one is stocks. Okay, stocks. What the heck is a stock? So you hear all these stories about stocks, right? You hear about people making a bunch of money in stocks, and very seldom do you hear the negative stories about the people losing small fortunes in stocks. So a stock represents equity. It represents ownership in a company. So if you own a stock in McDonald's, what it means is that you own a piece of McDonald's. If you own a lot of stock in McDonald's, that means you own a much larger piece of McDonald's. Okay? A lot of times institutions invest, they're called institutional investors. They buy huge blocks of stock in particular companies, and they become somewhat decision makers in the company because they're such a large shareholder. What's beautiful about stocks is that you can make a whole bunch of money in stocks if the company does well. But if the company does poorly, you can lose your shirt. As a matter of fact, you can lose everything. So you got all sorts of examples when it comes to this. Everybody remembers Enron, MCI, WorldCom. These were massive companies that went bankrupt. I heard last week about a company, can't think of the name right now, but it was kind of like a MasterCard Visa in Europe. And apparently there was some shady business going on there. There were $2 billion that came up missing. And they went to investigate this particular company. And after they got into investigation, they arrested the CEO. And shortly after that, the company went bankrupt. So these stories, they happen. And I don't want them to discourage you to become an investor in stocks or in the stock market, but they're a cautionary tale of the complexity that the stock market is. So stocks represent equity, stocks represent a lot of upside, and stocks represent maximum downside. Okay? Let's move on to the next topic. We're going to talk now about bonds. Bonds. Now, just like you have the stock market, you have the bond market. Okay, there are many different types of bonds. Now, traditionally speaking, bonds tend to be considered much safer investments, mainly because they kind of pay you an interest payment, right? So you hold these bonds and you get paid an interest payment. When you hold individual bonds, you actually own that particular bond. We'll talk about mutual funds and ETFs later. But when you own an individual bond, as long as the company doesn't go bankrupt, let's say you own a 5-year bond, as long as the company doesn't go bankrupt, they pay you interest payments at the end of the term, you get all your money back. So that's pretty cool, right? So long as the company stays healthy, because the bond is nothing more. The bond is a promise to pay you. You become a creditor of the company. So another reason why bonds tend to be considered safer investments is if the company ever became insolvent, or in other words, they went broke. You're in a way up in the hierarchy. You're like a creditor, right? So if they start to liquidate assets, let's say, I don't know, you own a tractor company, and then you bought one of their bonds, and they got millions of dollars in equipment. Well, once they sell the equipment, the office, if the company went bankrupt, right? Then there's a possibility you may get some of your money back when you're a bondholder, because you're a creditor. You're a liability to the company on their books. It's not like that with stocks. You're not a creditor. You're a shareholder, right? So bonds tend to be safer because of that. They also tend to pay less, right, than stocks, because you don't have that full upside. You're not necessarily an owner. You're a creditor of the company. There are many different types of bonds, right? Don't assume that because it's a bond that is safe. Take, for example, I had a conversation with a client a couple of weeks ago, and he's like, look, Joe, I need your help with my 401k. So I'm looking at helping him out with, selecting some things in his 401k. I also manage some money for him on my side. but I'm helping him with his 401k to make sure that all our strategies well coordinated and is disciplined amongst all the different accounts. And he's like, well, I like this bond better because it's paying 6% interest, and this one's only paying 2%. Well, there's nothing for free on Wall Street. Nothing. Okay? One of the things that you need to recognize is if a company is willing to pay you as a creditor a higher interest payment, it's normally because they have a higher a higher creditor risk. Just like you're lending money to a friend, right? If a friend has a high, if you lend money to a friend, right, and let's say you charge him interest, but he's paid you back 100% of the time, you might say, hey, look, just borrow the money, pay me a low rate, and I don't lend money to my friends, but I'm just making an example here. The point is, you don't need to charge them a lot of interest because you feel pretty confident about getting your money back. But if a company has a history of defaulting on their payments, maybe they didn't make some people whole in the past, well, if you're going to lend money to that particular company, you expect to get paid a much higher interest rate. Some bonds don't even pay interest at all. So the point is that the bond market, just like the stock market, there's a lot of options, there's a lot of complexity, and it's important that you understand all of the different factors associated with the bond market, okay? There's duration risk, so how long a bond is has a lot to do also with the risk. Say, I'll give you an example. Let's say I bought last month a bond that was paying 2%. And then the same company issued new bonds and they're paying 5%. Well, guess what's going to happen to the price of my bond? It's going to fall in value. Okay, it's going to fall in value because the new investors coming into the market, they don't want to buy my bond. They want to buy the new bonds that are paying 5%. Or they'll buy my bond, but I'm going to have to sell it to them for cheaper to adjust for the new bonds that are coming into the marketplace. And this is specific to people that own individual bonds. If you own bond mutual funds, you actually don't own the actual bond. You own a share in a mutual fund. So let's talk about mutual funds now, since we're on that topic. Our next topic is mutual funds. So mutual funds have been around a very long time. Now, mutual funds were a tool, I think it was well-intentioned, designed to help individual investors not blow themselves up. I sincerely believe that. I mean, because essentially what they did is that we're going to create a pool of investments. There's going to be, stocks, bonds, or a variation of such, and you're going to own hundreds of stocks and hundreds of bonds. So this allowed investors not to make speculative decisions. By default, they were more diversified just because they own more stuff. And that could be a good thing. Could be a bad thing sometimes too. Now, one of the challenges about mutual funds, and I've used them in the past. I've been in the industry now well over a decade, and I've learned a thing or two. I no longer use mutual funds, as I used to. It's been years since I've used, mutual funds heavily in my investment process. The reason being is because it's gotten convoluted. Mutual funds, oftentimes, they have professional managers. They get paid, okay? A lot of times investors don't see this, or it's embedded in the disclosures. And there's trading costs, right? So when they buy and sell stuff, there's trading costs. They got professional money managers, they make money. And then you got the financial advisor who puts you in that fund in the first place. They make money, and they could be making commissions as high as 5 or 6%. So you got all these fees. One of the things I learned over the years is that the further my client is from their money, the harder it is for me to manage that risk. And I think for me today, mutual funds, but I'm a financial professional, okay? So I understand the landscape. I'm giving you an overview here today. For me today, mutual funds means complexity in terms of I'm trying to keep track of who's getting paid, and that means less money in my client's pocket. So for that reason, I don't use mutual funds right now at all in my particular investment mix in the portfolios that I manage. If I can avoid it. And now, also history, the jury is out that, a lot of times these professional managers, they even underperform what the broad stock market does. So when they underperform the broad stock market, you're like, okay, I'm paying fees to these super smart guys that went to all these really great schools. But after all their fees, and, again, jury is out. The majority of them, their decisions are not as good as just following the broad market. Now, there are many different types of broad markets. You got the U.S. stock market, the European market, the Japanese market, the emerging markets, the Latin American markets. So you got all these different markets, right? And a lot of times these professional managers, in an effort to try to beat the market, instead of beating the market, they end up creating a hole for themselves, which then generates more activity, more trading, which tends, this is the reason why they underperform. Okay? For me, I think what I found over the years is the use of exchange traded funds, which is our next topic. Let's talk about ETFs. This is what they stand for, exchange traded funds. They follow an exchange. And exchange traded funds, just like mutual funds, you don't necessarily own the individual stocks. You don't necessarily own the individual bonds. You own a share of a fund. But one of the things I like about ETFs is that they follow the exchange. They follow the broad market. And this is just, for me, it's a move of humility, understanding that the majority of professional managers underperform the exchange. So it's not necessarily so much about overperforming the exchange. It's about owning everything most of the time. And if you feel really good about Latin America, then you put money in Latin American exchange. If you feel good about the United States, you put money in a U.S. exchange. And that's the way that I mix and match and diversify for my clients. But the use of all this complexity and all these tools and all these managers and all this stuff, I just think it ends up being a heavy cost to my clients, which ends up usually in underperformance in the accounts. Also, ETFs tend to be more tax efficient. So again, when you got all these managers, and listen, I really don't want to downplay this. They got people with entire teams of people, and they're trading, right, in the mutual fund side. And they're trading and they're trying so hard to make a name for themselves and beat the market. And some of them do. The research that I've seen, 15 and 20% of them do. But that means 80% of them don't. So I'm going to play the 80% side, right? So when they're sitting there trading, this caused cost for the clients, not only from trading cost standpoint, but guess what it also does? It creates tax burdens for investors. So, when a fund is selling all these things, some funds turn over the entire portfolio over 50% of the time. That means they sell half of the account in a year. So when they make a bunch of money on taxes in an effort to try to beat their indices so they can make a name for themselves, guess what? The tax bill they pass on to you. Now, you didn't call your investor and say, hey, my trusted advisor, I want to sell half of my account. You didn't call your investor and said that, but because of the managers that he hired to put your money in, they did that. They're going to create a tax liability for you. So ETFs don't do that because they follow the exchange. They tend to be more tax efficient. Not to mention they're some of the lowest cost investments in the marketplace today. To be able to get that diversification, that tax efficiency that most investors are looking for. So let's talk about some do's and don'ts here, okay? So listen, don't allow the complexity to not allow you to invest, okay? The stock market has been one of the most successful investment vehicles in history, okay? Depending on what research you look at, past performance is not indicative of future results, but the stock market has yielded from 1929 till now an average rate of return anywhere between 9 close to 10%. You can build a fortune like that if you're disciplined about your investment strategy. Okay? Next, don't assume that because you work with a financial advisor at a big name firm that they have the best vehicles. Don't assume that. Now, there's a lot of great financial advisors that work for big name firms that do a great job, that know what I'm sharing with you, and they work their behinds off trying to make sure that they're aligning their interest with their clients. Okay? But there are a lot of people that don't. There are a lot of people, it's easier to take somebody's money and just give it to somebody in New York and let them, manage the money, and then you have all the problems that I just described. So don't assume that just because you're working for a big name firm, big name bank, you're working with one of these companies, that your financial advisor has the best tools. Okay? Next, do work with the fiduciary financial advisor if you have the opportunity. I understand not everybody has access to working with a fiduciary advisor, okay? But do some research on what this means. Fiduciary financial advisor has a legal obligation to do what's in your best interest. The last time I did some research on this, less than 2% of the entire financial advisor population fall into this category. Well, if I go to my client and I tell them I'm not a fiduciary financial advisor, I'm telling my client I don't have a legal obligation to do what's in your best interest. So if I don't have a legal obligation to do what's in their best interest, then whose interest am I looking out for? My friends, listen, I want to say thank you for tuning in. We covered a lot of territory today. I sure hope you feel educated, empowered, motivated. Don't allow the complexity of Wall Street to prevent you from participating in one of the best investment vehicles in history. Don't allow that. I want you to become empowered. I want you to become educated so you can use Wall Street. Don't allow Wall Street to use you. If you feel lost, if you feel confused, if you feel like you don't understand, you should hire a financial advisor that has an educator mentality. I try to remind myself every single day, there is no stupid question. I tell my clients repeatedly, there is no stupid question. Ask whatever you want. Because every single question that my clients ask and every single question that I answer for them, they now become a little bit better investor than they were yesterday. So if your financial advisor doesn't have that philosophy, and I know they're out there because I trained under a lot of people that were like, I know everything, you know nothing. Let me tell you what you need to do. Some people have that bravado about their personality. I've trained under some of these folks, and a lot of these people are successful with that style. That style, it's not my style. I mean, it just goes against who I am. There's also other advisors who are very nice, but you still feel lost. You still feel confused. You still feel like you don't understand what you're doing. You don't understand the risk that you're taking for the reward that you're getting. You still don't have a plan, okay? And you still get nervous every single time the market gets really crazy. You see, the best time to have the rules of the game is before you start playing the game itself. You have a shot at winning the game if you have the rules of the game. And I believe that the rules of the game are captured via a custom written financial plan. So I recommend that you demand this from the professional that you're working with. If you don't have a written financial plan, send me a private message, whether it be through my podcast, through this video that you're watching here, or on my blog. And listen, if I can help you, I will illustrate to you how I can help you. And if I can't, I will point you in the right direction. My point is to help people, regardless of their financial situation. All right, my friends, thank you so much for tuning in. I appreciate you. Give yourself a pat on the back, because today you're smarter than you were yesterday. And I hope you learned a lot today, and you've done a lot to protect yourself and protect your family. See you in the next video, my friends. Talk to you soon.